Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, and today's special guest is Bob Wenzel. He is the chief editor of the Economic Policy Journal. Bob, thank you for joining us again, and Happy New Year.
Hi, Mo. Same to you, and it's always fun to be on the show with you.
Oh, same here. We're happy to have you back. So I want to discuss this podcast by talking about the Federal Reserve. They had their Fed meeting today, and in all indication, it looked like they are still wanting to increase interest rate, but it won't happen until the second half of this year. Now, do you believe them?
Yeah, actually, I do. What's really going on at the economy, with regard to the economy right now, is that it's turning around, and the Fed creates these boom bust cycles, but it is a cycle, and most of the indicators show that we're in a new boom phase. And the Fed is printing a tremendous amount of money, so they better start raising interest rates at some point, or they're going to run into severe inflation. I know most people are not expecting a major jump in price inflation, and the Federal Reserve certainly isn't. But I've got something called the EPJ Daily Alert, where I discuss trends that are coming up in the economy and what to do as far as investments. And I'm telling these subscribers to that now is the time to prepare for climbing price inflation. And I expect that it still may take a couple of months before it develops, or it may not happen to the second part of the year, but it's coming. And I don't think the Federal Reserve has a clue as to how serious it could be. So my guess is that not only will they start to raise interest rates sometime in the second half, but there'll be more than one hike in the interest rates, and they're still going to be behind the eight ball. They should first of all allow market rates to develop, but they won't do that. But they'll just raise rates 25 basis points or 50 basis points. That's a 0.25% or 0.5%, when they should be raising rates to, if they should be in the market at all, to somewhere between 3 and 5%. So it's going to be a mess. A big mess.
I agree, but I don't think they're going to raise interest rate, because I think they know the negative consequences, or you probably know them better than I do. But from outside looking in, I thinking that they know the negative consequences from increasing interest rate, like the pressure it puts on the federal deficit and the budget in this country. With every increase in percentage point in the interest rate, that more interest that the government has to pay on their debt. So I was thinking, go ahead.
Mo, that's very, very true. You're going to have two things. First of all, there'll be some pretty strong selling in the stock market, although I think it might be short-term in nature, because it's going to be a very, very small amount of a hike in interest rates. But I just think they're going to be forced to raise the rates, because I expect inflation to accelerate, and they're going to have to battle that. And they think they're going to be able to get away with small cuts in interest, small increases in interest rates. And the problem is going to be that they're just going to have to raise rates, but they're not going to do enough of a hike to slow the problems in the economy. And that is going to be a disaster. That's going to explode the deficit. And cause tremendous problems on that end, but there's no way out for these guys. No way out.
And don't get me wrong, I'm all for actually increasing interest rate, but I want it done by free market forces, not people
exactly.
in ties and suits determining how high the interest rate should be. Because I think it would be healthy for the economy, because it will clean out the disease and malfunction that we have in the economy, and make it function better with the capital realignment. And then also we'll have deflation, so people will start saving money, and then we'll have capital formation as well. So I'm all for increasing interest rate, but not just by the Federal Reserve. So I want to talk more about the implication of increasing the interest rate. Now, we talked about the federal deficit. We talked about the stock market. You think it'd be a short-term correction there. What about in other areas like the housing market, the precious metal market like gold and silver? And then like the derivative bubble, because in the derivative market we see a lot of currency swap and carry trade in that market as well. So it can be affected by a change in interest rate.
Yeah. See, I think people misunderstand interest rates. They look at an absolute number. For example, interest rates very low right now, and they say, if rates are higher, this is going to slow housing, this is going to slow the economy, so on and so forth. But if that's true, why isn't housing blowing through the roof right now? Because interest rates are as low as they are. There is not this direct relationship between high interest rates in housing and low interest rates in housing. I mean, we have to look at the model of what occurred before the financial crisis in 2008. Interest rates were much, much higher, yet housing was going through the roof. So what you have to do, instead of looking at an absolute number with regard to interest rates, you have to look at a relative number and say, okay, the Fed is increasing interest rates by 25 basis points, by 50 basis points, but where would market rates be at such a time when they're increasing them? And my best guesstimate at this point is they would probably be somewhere between 3 and 5%. So raising the interest rate to 2%, 25 basis points or 50 basis points on the effective Fed funds rate is not going to slow the money printing that's going on, which is really the fuel that will continue to boost the stock market, continue to boost housing, and fuel price inflation, especially gold and silver. You know, we're at a 9-month high on gold right now. I think, and this is something else I put in the EPJ Daily Alert, that gold has actually already bottomed for 2015. We saw our lows for gold on the first day that gold traded in January 2015, and it's not going to go back down that way. And likewise, with regard to interest rates, I think we've already bottomed with regard to interest rates, and we'll never see the low rates we saw, a couple of years back. So there are major trends developing right now that are very early stage trends that people still have the opportunity to get in on and be on the right way when these trends really take off. We're at a major inflection point with regard to many trends, and my advice to people is watch out. 2015 is the year of major instability, and you're going to see many different things happen that people don't expect. Higher than expected price inflation, probably in the second half. Higher than expected interest rates because the Fed will be forced to fight the inflation. I mean, to be clear, I think the Fed's real inflation target is 3%. I don't think it's the 2% they state, because they'll talk about noise, and well, if it goes to 3%, that's just noise in the system. But when it gets somewhere between 3 and 5%, then they're going to start being concerned, and they'll raise interest rates quicker than people anticipate.
Now, when you talk about inflation rate, you don't go by CPI, right? You go by another data and measurement, right?
I look at the Consumer Price Index, the Producer Price Index. I look at all of them. I mean, there's a lot of people that say, it's not an accurate measure, that, it's really the government is diluting the numbers, and they do in to a degree. But I'm more interested in the trend. Now, the key is that the Fed looks at the CPI, the Fed looks at the PPI, and they look at the GDP deflator, which is one of their key inflation things. So you have to keep an eye on those. However, to me, what's more important is the trend and what's going on, and the data really isn't hiding that. You're seeing a dip in the data right now in the price inflation indexes, because the oil and gasoline are going in price and are dropping in price, and that's really going on. There are other areas, food, for example, and rents that are climbing, but it's a mixed index. And I fully expect that these indexes will show, maybe not to the degree that of the actual climb, but they'll all show everything trending upward once the inflation moves into the next phase. So I don't think it's important to try and figure out the exact number. Just get the trend right, and you'll start to see the investments acting the way they should. Gold and silver will climb very, very high. Oil will bottom at some point and start to climb high, and interest rates are just going to climb and climb and climb, and bonds are absolutely the worst investment going right now.
I agree. So once if the Federal Reserve raised their interest rate, do you believe they will continue to raise interest rate, or are they going to pause and see what happens to the economy? The economy turns for the worse. Are they going to shift gears here and go back to another QE program and money printing?
Yeah, see, I don't really see that QE coming in, because first of all, that first interest rate cut is not going to do anything. It's not going to really slow the economy. You might have a pretty dramatic hit in the stock market when people panic out when they realize that interest rate increase is coming, but it's really not going to do damage. Again, you have to look at where interest rates are, where the Fed increases them relative to where they would be if the Fed wasn't intervening in the markets. And again, I think short-term rates would absolutely be somewhere between 3 and 5%, maybe higher. So if the Fed raises the target Fed funds rate to 0.5%, that's nothing. It's still causing a huge amount of money to be pumped into the system, and it's going to keep things on the upside. And the major concern is going to be the price inflation, and that's what's fooling everybody. There are very, very few people that are projecting the serious price inflation that I see coming, and I just think it's going to fool them all. Most of these guys, the Fed guys and most economists, are just trend followers. They have no theory on how the business cycle works. They have no theory really on inflation. And what they do is they look back 2 months and say, well, there hasn't been any inflation. Maybe it'll go up a little bit, but not too much in the next 2 months, in the next 4 months, in the next 2 years. You look at these Fed statements, and they're absolutely absurd. They're projecting 2% inflation years out. That's not going to happen. The inflation is going to be much, much higher, and the Fed isn't aware of it now. And when they start to battle it, and that's going to be the big battle, the battle is not going to be attempting to save the economy. The battle is going to be trying to slow down the inflation. They're going to be way, way slow in doing that. And you're going to have a period very similar to the late 70s, very early 1980s, when inflation was seriously, seriously out of control. And unless we have a new Paul Volcker, who knows what will happen. But Janet Yellen and her sidekick, Vice Chairman Stanley Fischer, are clueless as to the incredible inflation threat ahead.
Now let's talk abroad here. And lately, the EU has announced their own version of quantitative easing, and in result, the Swiss franc had depegged, or the people in Switzerland had depegged their currency, the Swiss franc, against the euros. Do you think other countries, like maybe China, will do the same if the U.S. continues its path of currency depreciation?
Yeah, I think that's a very real threat. What you really have going on now, first of all, Switzerland, the Swiss National Bank, really tried to protect that peg. They just had to absorb so much in foreign EU currency, euro currency, foreign reserves that they just couldn't take it on anymore unless they printed an enormous amount of new Swiss francs. So it's the markets that really forced them to abandon the peg. The same thing could happen with the Chinese peg, absolutely. Right now, we've got still quite a bit of dollar strength, so there's no threat in the immediate future with regard to the peg. But I don't think that's going to be the case longer term. The international banking system known as SWIFT, which is how international exchanges between banks are made, just announced that China's currency, the yuan, is now the fifth most active currency in terms of international trade. Now, that's major because what that means is there's a lot of people using the yuan. Excuse me, battling a little bit of a cold. What that means is the yuan is becoming a very important trading currency, and that eventually different central banks will start to use the yuan as part of their reserves, financial reserves at the central bank level. When that happens, what you're going to have is enormous pressure on the current peg between the yuan and the U.S. dollar. And I expect the potential for a speculator attack on that peg where the dollar absolutely crashes and the Chinese government will have to abandon the peg. So, yes, not right away, not next week, but down the road, absolutely. The same thing that happened to Swiss franc could very, very easily happen to the Chinese yuan versus the U.S. dollar, with the U.S. dollar diving on international exchange markets.
And we're seeing countries operate outside the petrodollar system and also the U.S. dollar, the currency reserve. Like, for example, China and Russia agreed to a currency swap. So that's one example of, like you said, why yuan is becoming a more and more active currency around the world. I think they're starting to make currency swap with countries other than the U.S. to protect themselves against the dollar.
Right, yeah, absolutely. And you see the United States threatening Russia with regard to banning them from the SWIFT system, which would be damaging for Russia. But all that does, it not only does it put Russia on alert, but it pushes all other countries, including China and any other country out there, that, hey, if we deal completely in dollars, if we deal completely with the SWIFT system, we're very vulnerable to the United States and their dictates. So everybody's looking at alternatives. It's insane what the United States government doing with these threats. It's pushing people away from the dollar, and at some place and some point, that push is absolutely going to work, and China, Russia, and many other countries are going to reduce dramatically their trading in dollars, and all those dollars are going to come back, hit the shores, and add to the price inflation that's going to happen anyways because of the Fed money printing.
Now let's talk about the financial war going on against Russia from the U.S. and the EU side. I want to talk about the unintended consequences that might come out of this. A lot of people are predicting maybe a World War III, or a lot of them are thinking that Russia will possibly dump all of their U.S. dollar holding from their reserve. And there's also a lot of other consequences, potential consequences out there. I want to get your thoughts on that.
Sure. I don't think we're going to see World War III because of the currency wars. I mean, I see some people out there making that claim. That doesn't make any sense for Russia. And what you have now is absolutely a bizarre attempt by the United States to surround Russia with the latest move in Ukraine. I mean, we know the coup was engineered by U.S. officials. They were caught on tape. And we know there's all kinds of U.S. operatives in Kiev now. So if there's any kind of threat, it's U.S. threatening Russia at this point, and Russia actually responding quite conservatively to the threat. But the dollar threat is the big thing, and if again the U.S.'s attempt is threatening to cause Russia to be pulled from the SWIFT system, and that would be a serious trading problem for the Russians, and they would have to do a workaround. But the eventual blowback from such a thing is only on the United States, because again, the more and more people see that the United States acts so ruthlessly, the more and more people are going to look for alternatives to the dollar, so they don't have to deal with that and be subject to those kind of threats. And that includes China, which is a major player, Russia, in the Middle East, Iran. I mean, these countries are all under pressure now by the United States financially, and they would be more than willing if they could come up with a system to work around that, so they don't have to deal with the United States. And what's of note is you see particularly Russia and also China accumulating a lot of gold. So who knows what that will mean long term? Maybe they'll do something to bring back some type of gold backing to their currency and enable strong trade, even if the United States isn't part of it. The U.S. is playing a very, very dangerous game with Russia and China at this point.
And also the possibility that Saudi Arabia might be involved in this financial war by manipulating the oil prices and making it go down from $100 to right now $45, which can take a big hit on Russia because the big part of their economy is oil. So
yeah, that's well, it's true that this is hurting the Russian economy. It's hurting lots of economies, Venezuela, for example, and Nigeria and things like that. But it also is damaging the U.S. domestic oil shale production. And if you really look at the numbers, what's really going on is there's been a tremendous increase in supply of oil because of U.S. oil production, and the Saudis just don't have the wherewithal to sort of stop their production to the degree that U.S. production is increased to keep supply and demand at the same level. So they're just printing and continuing to produce oil, and it's pushing the price down. And what this will do long term is really wipe out the U.S. Oil shale production. That's what's going to happen, and the oil will rebound for Russia. Most of Russia's oil production is not as high cost as the U.S. oil shale stuff. So they'll be able to, of course, Saudi Arabia is a very low cost producer. So they'll continue to be around. So what you'll see is a wipeout of a domestic U.S. production, maybe some production out of Venezuela and some other countries. And once that supply dries up, then you'll see a rebound in the price, and that will be beneficial, number one, to Saudi Arabia, but also to Russia at that point. So this is kind of a temporary thing for Russia. It's kind of a wake-up call and sort of gives them a reason to start considering diversifying away from oil and allowing other types of businesses and operations to flourish, because if they're too dependent on oil, they're going to suffer these booms and busts for their economy.
And also the rig count for the domestic shale oil producers in this country starting to go down too. Right. And then we're also seeing layoffs as well. So we're already seeing the negative consequences from the low oil prices. Right. I mean, it's nice to see lower gas prices, but there's other negative consequences to that. So let's talk about 2015, which in the first month of the new year. And I want to get your outlook for 2015, not just on the economy, but also politically and socially as well, because I know you cover politics and social issues on your website. So I just want to get your outlook for 2015 on that.
Sure, Mo. Okay, well, Mo, I really think it's going to be a year of instability. I mean, I think we first of all, from a financial perspective, we've already seen that with regard to what happened when the Swiss franc pulled the peg with regard to the euro. And there's just so much that's being propped up by central banks in so many different directions, and they can't possibly continue to prop everything up the way they are, because they're going up against the markets, and the markets have more force and eventually cause these central banks to reverse what they're doing, or it overwhelms what the central banks are doing. So I expect instability, especially in the second half of the year. I expect the price inflation to accelerate and interest rates to climb, and it just to be a mess, especially here in the United States. And of course, you'll have ramifications overseas. I think China is on the edge of maybe one of the greatest financial collapses ever. There's a lot of real growth since the days of Mao. The chains have sort of been taken off, and there's free market sectors that are really booming in China. but there's still a large government presence, and that's all going to collapse. They can't print that money anymore because China does have a serious inflation problem already, and the government has sponsored all kinds of building that's been measured in the GDP as part of the boom, but it's construction that has no value. There's over 80 million, and I repeat, 80 million apartments in China that are vacant, that were just built to goose the GDP numbers, and I question whether those apartments could even be occupied. I mean, if builders see that these things are pretty much ghost towns and no one's actually living in them, why would they put serious materials in them in the construction? So the potential collapse in China is just of a degree that you really haven't seen before. So that's something to look out for as far as the China is concerned. Back in the U.S., we'll be getting closer to the 2016 primaries, so you're going to start to see a lot of focus on the presidential candidates, and who knows where that takes us. We've got an simmering unrest in the country with regard to police, and especially when they shoot a black person. So if you get another shooting like that, you could have protests again. It's and you're getting technologies that in some cases will move us towards freedom, but in other cases will make it easier for the government to monitor us. Fortunately, they're very bureaucratic and very slow, so they're not very good at this stuff. But they do it, and it won't be good overall. They'll be able to do a lot of tracking and a lot of recording and enforcement of a lot of laws they have on the books that they haven't been able to enforce before because of new technologies that will allow them to monitor what we're doing. So that's never good. And but overall, I'm sorry. Go ahead.
I'm sorry. Like for example, digital currency. That's something like Bitcoin. That's something the government concerned about, but they also look at the positive. Like they can track people's transaction more compared to people that pay their transaction in cash where they can't track it. So right. I think government will embrace digital currency in that sort of way. So I think that's one type of technology that's good, but bad because now government can track you even more.
Right, exactly. See, I think there were a lot of libertarians that jumped on the bandwagon early on with Bitcoin, and I think they're beginning to realize that, hey, this is not a libertarian solution. It is a very trackable. Once the government gets a clue as to who you are and what wallets you're using and all that, they can see everything, and it's very, very difficult to sort of hide your steps to be completely anonymous, especially now when in order to buy Bitcoins you technically have to identify who you are. You know, they're continuing these news reports about all these Bitcoin cash machines that are showing up, but they don't tell you that they take your fingerprints, your picture, your driver's license, and all kinds of other things before you get any Bitcoin. So all that is very, very trackable, and we can see what's happening with regard to Ross Ulbricht, the founder of Silk Road, and the trial that he's going through right now. I mean, it's terrible as far as the degree to which Ulbricht's entire operation has been exposed because the government's been able to track his Bitcoins and what he did with them. It's very, very dangerous stuff. And, hopefully libertarians are waking up to that and realize that, cash and gold are a lot less trackable, traceable. And the old Swift proverb, gold has no smell, continues to hold. If you have a gold coin, you don't know. There's no smell or odor as to where it came from, where it's going, or anything else. Not trackable.
I agree with you there. That's one of the advantages of buying gold, silver, and holding cash. The government can't track you down that way. So one final question before I let you go. I want to ask you about your investment strategy based on the current market condition. Now, we talked about the increase in interest rate in the second half of this year. well, from this podcast, it sounds like you still believe people should still buy gold and silver despite that possibility, and then also talk about other sector that you think people should invest in.
Yeah. Well, again, I talk about this on a daily basis at the EPJ Daily Alert, and to find out about the EPJ Daily Alert and everything else I write about, people can go to economicpolicyjournal.com, and they'll find it all there. If you just Google EPJ, most of the time it's the top link. Sometimes it's the second link. But Google EPJ, and that'll get you to my site. But specifically what I'm recommending now is that gold and silver be aggressively accumulated. I think they're eventually going to hit new highs, and I think they're at an absolute bargain price right now because there are very, very few people that are expecting the inflation I'm expecting. So therefore, inflation assets like gold and silver are very low price relative to where they're going to be. I also like as an investment oil stocks based upon the fact that I do expect them to bottom sometime within the next 6 months or so and climb up after that because of the accelerating inflation. So I'm advising a little bit on that, a little bit of purchase. I'm telling people to absolutely avoid the bond market. It's a very, very dangerous place to be. But I'm also telling people to hold very large positions in cash right now because I think it's going to be a very unstable period, and there are going to be situations where market's going to break, there's things going to be crashing, and it's going to be a great, great time to buy some real bargains. So keep the cash levels high and watch for those opportunities.
And for people that are looking for yield, I think the oil sector provides great yield, especially for the big cap oil companies like Chevron and Exxon,
right,
and et cetera. So if people are looking for yield, better yield compared to the bond market where you're pretty much getting negative return if you factor in inflation, I think the oil sector provides a good opportunity right now for investors.
Right, that's a very, very good point. The bond market, in addition to the fact that even if they had high interest rates, I would still tell people to avoid them because I think they're going to drop, and if people hold them to maturity, they'll lose value based on purchasing power, so it makes no sense at all to hold them. But you're right, in addition to all that, the yield is very, very low, and comparable yields on major oil companies are much, much higher.
Okay, Bob, well, thank you for coming on for Wall Street from Main Street podcast. As you mentioned a few minutes ago, people want to check out his work. They can go to his website at the economicpolicyjournal.com, which is very popular within the libertarian community. I heard that Ron Paul goes to that website often. Is that true?
That's what Jeff Dice, the chief of staff, I interviewed Jeff Dice, who was Ron Paul's chief of staff, some time ago, and that's what he mentioned, that Ron Paul visited the site daily. So I'm proud of that.
Yeah, it's a great compliment for you. Your website is very good for any libertarian looking for information on social, political, and economic issues. So, Bob, thank you for joining us, and hopefully you can come back on again soon.
Sure, my pleasure. Thanks very much, Mo. Take care.